Hi there, I'm Ben Jones and welcome to the second part of your investing outlook for 2015, brought to you by Dukascopy TV and investing.com. We'll be discussing even more forecasts from some of investing.com's top contributors, finding out where their focus will lie in the new year. Matthew Weller has outlined that the general consensus is to be short on Euro-US dollar at the start of 2015, stating that it's logical because of the potential rate hike within the first 6 months of 2015 and the acceleration of the US economy. He outlines that the problem with this view is that the impact of these bearish catalysts for euro-dollar may be priced into the market already. The pair has already fallen a staggering 1,800 pips in the last 7 months of 2014, and sentiment is near a historic bearish extreme. Mr. Weller concludes via a quote from Mark Twain that implies one should question themselves if they're on the side of the majority, and that the consensus is a dangerous place to be, stating the euro-dollar could end up rallying strongly in 2015. Next up, and two outlooks from two different contributors favour two different commodities in 2015. Firstly, Gary Tanashian feels that out-of-favour gold will have its day in 2015. Although gold has been grinding down recently, this is not the reason for the investment. Mr. Tanashian outlines the key is not to chase inflation around when considering gold stocks. It's to watch gold versus mining cost inputs, including human resources and expectations for prosperity, i.e. economic growth, the stock market. Gold versus crude oil and energy resources has been rising sharply. That is a positive, and that the mining product is outperforming a mining cost. Joseph Schaefer actually believes the most attractive returns in 2015 will come from the oil and gas industry. Mr. Schaefer describes the recent approach of OPEC as if they are living in the 1970s still, and his strategy is as follows. They are playing the likelihood of OPEC's disintegration or descent into insignificance by purchasing long-dated calls on the big integrated oils and ETFs like the SPDR Energy Select Sector Fund. This way, they deploy very little capital, gain great leverage, and can never lose more than their small investment. It's possible oil companies will remain where they are or decline over the next 2 years. Anything's possible, he just believes it's highly unlikely. And our final two contributors have analysed the equities route in 2015. First up, Urban Carmel sees a fall for US equities next year, despite the expectation of the US economy continuing to soar. He outlines, for the past 3 years, equity prices have run up much faster than either corporate revenues or earnings. This makes them expensive on any number of metrics. Price-sales ratios, for example, are nearing the highs from 2000. The remarkable run higher in equities has also made investors sanguine about future appreciation. Contrarians take note. Retail investors have a greater allocation in stocks now than at any time other than during the late tech bubble period from 1998 to 2001. Theo Burken is actually interested in investing in equities for at least the first few quarters of the year. However, he would avoid the S&P as well, stating that they seem overvalued at the moment, and even with the prospect of them being further overvalued, he would prefer to buy into equities that seem cheap at the moment. Additionally, he added, when it comes to other asset classes, he continues to hold all of his cash in US dollars. The US dollar index has been through a very powerful rally. Entering into 2015, we could easily see a shakeout in the form of a meaningful correction, as many hedge funds hold large net long positions. However, eventually the dollar should continue its run for a while longer because the world will continue its easing programs, weakening their own currencies. Well, that's all for this edition. Thank you for watching, and make sure you stay tuned as your regular market glance will resume again next week. Bye for now.